Welcome back to Investing Talk Podcast.
Today, we are looking at a company that sits right at the intersection of, well, massive hype and some very hard reality. We're talking about Nebius Group.
And as usual, before we start, subscribe, like, and comment on this video to support the show. It really helps us out with the algorithm and keeps these breakdowns coming.
So we've covered a lot of AI software companies recently. You know the type, the wrappers, the chatbots, all the tools that kind of sit on top of the models.
Pass that light, yeah?
Exactly. They scale with code. They're everywhere. But Nebius is different. This isn't software. This is hard infrastructure. This is heavy metal.
Heavy metal and, let's be honest, incredibly heavy spending.
Well, that is the trade-off. But just look at the setup. Nebius is currently sitting on a $20 billion backlog of secured contracts.
$20 billion.
$20 billion. And we aren't talking about small players or, startups that might go bust next week. We are talking about the hyperscalers.
So companies like Meta, Microsoft, the big guns.
The biggest. They have pre-sold their capacity for years out.
Which sounds fantastic on paper. I mean, a $20 billion pipeline is the kind of number that makes growth investors just drool.
It is.
But here's the context we have to establish right off the bat, and it's why I'm looking at this with a raised eyebrow.
Hey.
While that backlog is massive, the company is burning an incredible amount of cash to actually build the infrastructure to service it.
Yeah.
It is literally a battle between a guaranteed pipeline of money and the sheer crushing cost of execution.
That is the core tension here, 100%.
Yeah.
Can they build it fast enough to cash those checks before the cash burn eats them alive? It's a race.
So let's unpack this.
Yeah, let's start with the fundamentals, because the numbers here are, frankly, disorienting.
You really are. Let's start with the growth argument, because the velocity is startling. We aren't looking at a slow ramp up here at all.
Right.
In the first 9 months of 2025 alone, revenue didn't just double, it surged 437%.
Whoa, 437. Yep.
They hit over $300 million in revenue just as a warm-up.
Okay, 400% growth is, well, it's tech bubble numbers. But let's play devil's advocate for a second. $300 million is still a long way from the valuation they're asking for.
It is.
You can't justify a $25 billion market cap on $300 million in sales unless you believe in a miracle.
True, but that $300 million is looking in the rearview mirror. The consensus on the street, and this is where it gets wild, is projecting revenue to catapult to nearly $3.5 billion by 2026.
$3.5 billion.
And management is even cockier. They're guiding for an annualized revenue run rate, or ARR, of $7 to $9 billion by the end of 2026.
Hold on. Pause. Going from $300 million to a $9 billion run rate in, what, 18 months?
18 months.
That requires absolute perfection. How do they even justify that kind of confidence? Is it just raw demand?
It's demand meeting a moat. Nebius isn't just renting out server rack space like a generic data center. They are a vertically integrated NVIDIA cloud partner, which means they get the VIP treatment from Jensen Huang.
Exactly. It's not just a badge you put on the website. It means they get the Rubin platform and the Vera Rubin NVL72 systems before the general market.
Okay, for the listener who isn't a hardware geek, and frankly for me too, why does the NVL72 matter so much? Is it just a faster chip?
It's not just speed, it's architecture. Think of it like this. Traditional data centers are like a city grid with traffic lights.
Okay.
Cars or, data packets have to stop and start. The NVL72 allows massive clusters of GPUs to talk to each other almost instantly, like a superhighway with no speed limit.
Oh, I see.
If you are Meta or Microsoft and you are training a trillion parameter model, you need that specific architecture to get the training done in weeks instead of months.
So if Nebius has the superhighway and the other guys are still just building the on-ramps.
That's it. If Nebius has it and others don't, you literally cannot afford to switch providers.
Yeah.
That creates a massively sticky customer base. You aren't going to leave because you can't get that performance anywhere else.
Okay, I see the growth argument. If they hit those numbers, the stock looks cheap today. But let me put my skeptic hat back on, because we need a reality check on the cost of that growth.
Go for it.
You mentioned the revenue surge, but what about the bottom line? In 2024, they saw a 236% earnings decline.
Because they are spending everything on hardware. They are buying the shovels for the gold rush.
Right, but they are losing money hand over fist to buy those shovels. And if we look at the valuation, the market cap is sitting around $25 billion.
Mm-hmm.
Depending on which metric you look at, the PE ratio is either Negative, specifically negative 130, or strictly theoretical at around 106.
It's a growth stock. You pay for the future earnings, not the current ones.
I get that, but you are paying a massive premium right now for profits that are supposed to arrive after 2026. The entire thesis relies on them maintaining a 50% or higher compound annual growth rate. If they slip even a little bit, that multiple just collapses.
That's the risk.
And there's another number that worries me. Headcount.
You think they are bloated?
No, the opposite. They only have 1,371 employees.
That's lean. That's usually good for margins.
It's great for margins if you're a software company writing code in a coffee shop. But remember what you said. This is hard infrastructure. They are trying to deploy $20 billion worth of complex physical assets, building data centers, installing massive cooling systems, physically racking thousands of heavy GPUs. Can you physically execute that level of logistical complexity with fewer than 1,400 people?
That is a valid concern. It's a lot of pressure on a small team. It creates a bottleneck risk where the money is there, the chips are there, but the people to install them just aren't.
Exactly. But let's pivot to the charts, because despite my fears about the headcount and the cash burn, the market seems to be telling a specific story.
It is. So let's look at the technicals. As of January 30th, 2026, the stock is trading right around $99.20.
Psychologically, that $100 level is always a battleground.
It is. But if you look at the structure, boring is actually good right now. It is currently in what technical analysts call a bull flag pattern.
Which implies it's just catching its breath.
Exactly. The stock had a parabolic move. It shot up massively vertical. Now it's consolidating. It's drifting sideways or maybe slightly down on lower volume. It looks like a flag on a pole.
Okay.
Typically, this is a pause before the next leg up. It tells me the frantic buying is over. But crucially, the panic selling isn't happening either.
So the trend is still intact.
Very much so. It's holding above its key moving averages, specifically the 50-day at $93.66. And you have to look at the range.
Yep.
The 52-week range is wild. The low was roughly $18. The high was $141. That is a 671% move from the lows.
Which brings me to the risk metrics. Because if you are buying this stock, you really need to understand what you are signing up for. The beta is 4.0.
That is sky high.
For context, a beta of 1 means you move with the market. A beta of 4 means if the S&P 500 drops 1%, Nebius is likely to drop 4%. If the market sneezes, Nebius catches the flu. This stock moves 4 times as hard as the market. It is not for the faint of heart. You have to have a stomach of steel to hold this through a correction.
No, it's definitely high octane. But looking at the volume, we are seeing about 11 million shares trading hands. That is slightly below the daily average, which, it confirms that consolidation thesis people are holding.
Everybody is waiting for the next catalyst. The RSI and mass PD signals are pretty mixed. The stock is taking a nap.
Well, while the traders are taking a nap, let's look at what the street is saying, because the analysts seem to have made up their minds.
Okay, go on.
The analyst consensus is overwhelmingly positive. 75% of analysts covering the stock rate hit a buy.
75%.
And the average price target is $142. And you have Northland on the high end with a target of $211.
That implies a double from where we are now.
Exactly. And it's not just talk. We are seeing institutional flow. Fred Elger Management just added Nebius to its small cap focus fund.
Okay, so that's smart money accumulating shares.
Right. They see the growth trajectory and they want in before the earnings really hit.
Okay, but there's another group accumulating shares, or rather betting against them. We have to talk about the shorts.
The short interest is sitting at 15.47%. That is high.
It is very high. That means a lot of people are betting this execution fails.
True, but that can also be rocket fuel. If Nebius hits their numbers, those shorts have to cover. They have to buy the stock back to close their positions.
A short squeeze.
It could send this thing vertical, especially with the float being what it is.
That is the bull case for the short interest. But we have to look at the sentiment drivers. It's a real tug of war right now. The weighted sentiment is mixed. On one hand, you have the backlog excitement. On the other, you have bearish headlines dragging it down. Specifically, the news around Trump tariffs and the broader sell-off in AI infrastructure we saw around January 20th.
The macro noise is definitely loud.
And it's not just macro. There is some internal movement, too. CEO Arkady Veloz and Director Kira Rudinsky have been selling shares.
Now, to be fair, looking at the filings, that looks like tax loss harvesting or maybe rebalancing. The amounts were pretty small relative to the market cap. It's not a dump.
I agree, it's not a mass exodus. But insider selling during a massive growth phase, it always raises an eyebrow. If the CEO is selling, even for taxes, it tells you they don't think the stock is going to double tomorrow. If they thought it was going to 200 next week, they'd find cash somewhere else to pay the taxes.
That's a fair point. But look, we have to talk about the risks that could derail this thesis entirely. Because a $20 billion backlog is great, but only if you can deliver it.
And this is where the bear case really have teeth. We need to talk about the boring stuff that actually kills companies. Logistics. And the back office.
Okay, let's break it down.
The biggest risk is purely execution. Like we said, that contract pipeline creates a massive logistical headache. They need to build data centers, secure power, install cooling, rack the servers, and get the software running.
Right.
Any delay, a supply chain snag, a permit issue for a building, a delay in chip delivery, and those margins get absolutely torched.
And the market is priced for perfection.
Exactly. Then you have the CapEx burn. They are burning cash to buy these GPUs.
Yeah.
If utilization rates don't hit 100% immediately, the debt and cash burn becomes dangerous.
Yeah, these chips depreciate. You can't just have them sitting idle.
It's like buying 1,000 Ferraris and letting them rust in a garage. You lose money every second they aren't driving.
That's the classic infrastructure trap.
Then there is the macro policy. We mentioned the Trump tariffs. Nebius has a significant footprint in Europe. If the U.S. administration slaps tariffs on European goods or data services, or say restricts American chips going to certain European data centers, that hurts their economics significantly.
It complicates the cross-border data flow for sure.
And finally, there is a specific red flag in the recent news that I really don't like. There have been mentions of potential scrutiny over electricity costs and, more concerningly, financial audit controls.
Audit control deficiencies.
That is a scary phrase for any investor.
It is.
When I see the phrase material weakness in internal controls or audit deficiencies, the hair on the back of my neck just stands up.
Yeah.
We're talking about a company trying to deploy billions of dollars. If your internal accounting team is messy, if you don't know exactly where every dollar is going, that is a recipe for disaster.
It's a scary phrase, I grant you that. But we have to contextualize it. This is a company growing revenue at 400%. Often, the sales team sprints a mile ahead of the accountants. It doesn't necessarily mean fraud. It usually just means growing pains.
Growing pains is the polite term. Lost cash is the impolite one.
Yeah.
And combine that with the power scrutiny. If they miscalculated their power arbitrage, especially in Europe where energy prices fluctuate wildly, those projected margins could just evaporate.
I hear you. Those are real risks. But let me offer the rebuttal.
Please do. Give me the silver lining.
On the macro side, the European footprint, the thing you're worried about regarding tariffs, is actually a hedge. It's regulatory arbitrage.
How so?
You have European companies and even U.S. companies that are worried about U.S.-China chip restrictions or data sovereignty. They need a non-U.S. jurisdiction to operate in. They need a place where their data is safe from certain U.S. regulations. Nebius provides that. It's a safe harbor.
So the tariff risk might actually be a feature, not a bug.
In some ways, yes. It positions them as the alternative. And on the execution risk, yes, it is hard. But the NVIDIA partnership is the mitigation. They are first in line. They aren't waiting for chips like the smaller players. NVIDIA has a vested interest in Nebius succeeding to show that their Rubin platform works at scale, that supply security is worth its weight in gold.
So what's the final verdict on Nebius? We have a massive backlog, huge execution risk, a lean team that might be too lean, and a chart that is taking a nap before its next move.
I'm going to give this a bullish score of 7.5 to 8 out of 10.
That's pretty high given the risks we just discussed.
It is, but look at the thesis. This is a play on the infrastructure layer of AI.
Right.
We aren't betting on which chatbot wins. We aren't betting on a specific app. We are betting on the road they drive on. You have multi-year visibility with a $20 billion backlog from the biggest companies on Earth, Meta and Microsoft. You don't get better credit ratings than that.
So what is the trade? How do you play this?
Short term, you are watching for the Q4 earnings in late February 2026. A beat there validates the execution. If they show they are recognizing that revenue and keeping costs somewhat under control, the stock pops.
And long term?
It's a 12 to 36 month hold. If margins turn positive in late 2026 as predicted, the stock re-rates significantly higher. We are talking about a company potentially doing $8 billion in revenue with high margins. The current price will look like a steal.
And don't forget the catalyst in March.
The NVIDIA GTC conference, that is the hype event. Nebius will be front and center with the Rubin platform integration. That is going to keep the narrative strong.
All right. My conclusion is a bit more cautious. This is a high-risk, high-reward play. It is only for those who can stomach that beta of 4.0.
Absolutely.
If the market corrects, this will correct harder. But if you believe in the infrastructure build-out, the numbers are compelling. It's basically a lottery ticket, but one where the payout is backed by Microsoft contracts.
It's definitely not a stock to put your rent money in, but the upside is hard to ignore.
That's the breakdown on Nebius. If you found this valuable, make sure to subscribe, like, and comment below. We'll see you in the next episode.
Thanks for listening.